you for joining the webinar on the Pengana Global Private Credit Trust, or PCX as we like to refer to it. My name is Chris Boyd and I'm part of the sales and distribution team here at Pengana. As a quick reminder about PCX, it was IPO'd on the 21st of June 2024. The trust seeking to provide investors with a diversified exposure of global private credit, with the portfolio containing over 20 managers and over 2,000 individual positions. These positions are inside companies that exist broadly within the USA and the European regions in the world. Delivering monthly income of 7% on a growing net asset value, it was the first listed investment trust that also had a quarterly buyback whereby the manager, us being Pengana, will buy back the units at NAV from any investor that is wanting to sell at that point in time. This has seen the fund, since its inception, trade broadly in line with their net asset value, which has been really pleasing to see. I'll shortly hand over to Naomi Richardson and Adam Rappaport, who will provide an update on the portfolio, what we're providing access to, the challenges that we're seeking to address, and importantly, why we see this as a compelling reason to invest into the fund. Naomi is the CEO of the Pengana Private Credit Fund, and Adam is the portfolio manager who has the responsibility for managing the liquidity and the hedging mechanisms inside the trust. They'll present for roughly 25 minutes, and after that, there'll be time for questions. If you do have any questions that you'd like to answer, you can put that in the Q&A box and we'll seek to get through as many of those as we can. And if we don't get to them, we'll come back to you after the session today. I'll now hand over to Naomi.
Thanks to you all for participating in this webinar this morning. Adam and I are really pleased to be here to talk to you about PCX and about global private credit more generally. And we really appreciate your time and attention and hope you're going to find this webinar to be of value to you. So really just wanted to quickly start with a recap of who we are and what we do. So Pengana Credit was actually founded in May 2022 with the purpose of providing Australian investors with diversified access to global private credit. Now, global private credit is a very attractive asset class that we think should be included in all portfolios, given it delivers very attractive risk-adjusted returns and low correlation relative to other asset classes. It's got low volatility and has a very large and diverse opportunity set available that allows you to provide a high level of diversification and resilience with those returns. And I think importantly, also provides a diversification from Australian private credit. Now, because global private credit has not traditionally been widely available to Australian investors, but it has been very sought after by large institutional investors for those characteristics, we wanted to set up a vehicle that actually sought to overcome kind of the barriers to access to the asset class, whilst also providing a wide level of diversification. So to address the access challenges, Pengana Credit partnered with Mercer to build a very highly diversified master portfolio, as Chris mentioned before, that has 20 top-rated managers by Mercer with over 2,000 underlying loans that delivers a platform for us to be able to provide investors with a range of investment solutions that are differentiated by return objective, risk tolerance, and liquidity requirements. So we now manage about $400 million of capital across 4 distinct access points, and each one of those solves a particular investor need. With that, if we just go to the next slide. So what I'm going to cover is just really recap for you what is global private credit and why you should invest in it, what the current market environment is for global private credit, which we think continues to remain very favorable, how our portfolio is positioned within this context, and then we'll provide some comments on performance of the fund and outlook. But just really to quickly recap of what we mean by global private credit. Now, this is predominantly bilateral loans that are made to mid-market companies in the US and Europe, the largest and most mature and innovative markets for private credit. The reason the opportunity exists is because banks have exited lending to companies in the mid-market due to an ever-growing burden of regulatory restrictions that have actually been put in place by regulators in the US and Europe post the GFC. So in these markets, while the banks would love to be able to continue to do the business in mid-market, the regulators don't really like them using short-term deposits to fund long-term assets, because these loans could be anywhere from 3, 5, 7 years in duration. So they've made it very unattractive to do so relative to other capital deployment options by increasing the amount of capital a bank has to hold for every loan that they make to a mid-market company. And this is why the banks have effectively sort of exited mid-market direct lending. So what we then have is a growing supply-demand imbalance, which you see on the left side of the slide, which 84% of the market is actually funded by private credit versus 16% that's done by banks. And that's really been created by the bank withdrawal. And on the other side, you see the rapid growth in the market as a result, as institutional capital that's come into fund managers has come in to sort of fill that gap. And that growth really reflects a structural dynamic that's actually driving these attractive characteristics. So if we go to the next slide, the characteristics that investors are attracted to in this asset class. Firstly, you get attractive returns because the lenders are being compensated for holding the debt to maturity, because these loans don't trade like you'd find fixed income trading in debt markets. Well, these don't trade. And as a result, you get low volatility because these things are held to maturity. And people are very attracted to the high capital preservation characteristics, given the focus of the lending is getting your interest payments and the principal back. And so the loans come with structural protections, and the managers very closely manage each individual loan to ensure that they get the interest payments and principal back. Now, what's great about US and Europe, because of the maturity of market and the size, you get a very wide variety of strategies to choose from, which allows you to get very different risk return profiles and allows for very wide diversification in the portfolio. So just to the next slide. So kind of what you have now in the US and Europe is a very large market that has experienced managers with long track records of success across three main buckets of strategies. So in addition to direct lending, which I kind of briefly mentioned before, you also have structured finance, which is basically loans that are made to finance pools of assets. So for example, non-bank originators of loans, like working capital loans to companies or residential mortgages, could be funded by a structured finance private credit manager. And then the other category is credit opportunities. Now, credit opportunities funds invest in senior secured loans where the counterparty has a financing related issue that needs to be addressed and then requires the highly specialized skills of private credit managers to solve. So by having access to all three of these buckets of strategies, it allows us to maintain resilience in our portfolio, while also providing opportunities to take advantage of market disruptions that can occur through economic cycles to generate some attractive additional returns. So if we just go to the next slide, I just wanted to quickly touch on, before delving into what's happening in private credit markets, kind of the main differences really between Aussie private credit and global private credit. Now, firstly, if you see in these pie charts on the right, the relative size is there to say, the US and European markets for private credit, $1.8 trillion market growing very rapidly relative to estimates of the Aussie private credit market, which is around 220 billion as it sits today, but it is also growing. Now, the other key differences is in the US, you have a very wide range of strategies that allow you to diversify. In Australia, the vast majority of private credit is commercial real estate, and generally in areas where banks don't have risk appetite to lend. So in kind of very large leverage buyout type transactions or mezzanine positions in asset-backed portfolios. And so, what you then get between the two is the opportunity, I should say one other thing, which is in the US and Europe, it's a much more mature market. So you have, quite a lot of managers who actually have track records of performance that go right back to the beginning of the industry, really, to the GFC. So what this provides is, a really nice diversifier. If you're in Australian private credit, what global can do for you is actually provide a really nice diversifier in what is a very mature but still high-growing market because of the structural opportunities that are available that I discussed before. So if we just go to the next slide, just really to touch on what's actually happening in the current market for global private credit. Now, the first thing to mention, as you probably have all seen, interest rate cycle is actually easing in the US and Europe. And so you're seeing base rates start to come down. And it appears that inflation is under control. It appears that, particularly in the US, they've achieved a soft landing for the economy, but everybody or all the commentators, credit funds, and regulators still remain very vigilant in this environment to keep track of what might be happening with inflation, but also what's happening in the underlying economy to try to achieve that soft landing. Now, Europe is easing, but the growth is very anemic. And then we have ongoing political risks that remain in the background. So when you have this uncertainty and risk, there's still an ongoing expectation in US and European markets of volatility to continue in both equity and credit markets. So within this context, global private credit represents a great way of getting defense in your portfolios, given the focus is on defensive sectors, high quality borrowers. And so you get a nice buffer of stability against market volatility within your portfolios by allocating into the asset class. Now, more specifically within the market backdrop, our thinking is, number one, we're going to continue to see attractive opportunities across all of our strategies, particularly for large managers that have long track records of performance and very strong origination. As lower interest rates mean more companies are going to be willing to continue to invest, there'll be more M&A activity, and the private credit managers are really starting to see activity underlying or investment activity increase. Secondly, given the loans are floating rate, low central bank rates means an improvement in the cash flows of borrowers, which improves their credit quality, which reduces the risk to lenders. Thirdly, transaction pricing and protections still remain quite attractive in the core markets that our managers participate in. The asset quality within our managers' portfolio of loans remains very strong. And then there's lots of attractive opportunities for specialized credit opportunities managers, because there's a large number of companies or banks who have liquidity issues that still require bespoke solutions, or companies who need to refinance or restructure their balance sheets who have very few options available to them to do so. So the environment remains very attractive for all those reasons. And given the quality and the proven skills of the managers in our portfolio and our wide diversification, we feel like we're very well positioned to be stable and resilient, irrespective of what actually happens in the economic environment. So just to the next slide, please, Dean. So I think it's really important for everyone to understand that that our portfolio is very deliberately structured to perform across a constantly changing kind of market environment. So to really highlight some key points here, firstly, we've got very experienced and proven managers that focus on providing senior secured loans to defensive, non-cyclical companies, and they have very strong protections and they manage them very closely. And importantly, they're pointed at areas of the market where there's a supply-demand gap that's driven by ongoing bank withdrawal. And that's really because we want to be places where you can maintain that structural premium. We don't want to be in situations where it's actually more acute and things can change quite dramatically. Secondly, because private credit is illiquid in nature and you can't trade in and out of it easily, we've designed the portfolio to not only be stable and resilient, but also flexible enough to take advantage of relative value opportunities that may arise through volatility or dislocated markets or other changes in market dynamics. Thirdly, it's very diverse. Why is it diverse? Because with credit, you don't share in the upside the way an equity investor would. So we focus on minimizing downside. And so given you can't trade in and out of it, the way that you mitigate risk in the portfolio is by minimizing loss and getting wide diversification. So we're across geographies of the US and Europe because they're the largest, most mature markets for private credit. They provide economic diversity at the macro and micro level. There's very wide industry diversification and lots of individual borrowers, as we've said a few times, over 2,000. Now, this helps us mitigate any concentration and correlation risk, and it reduces our reliance and exposure to any particular economy, manager, industry, or borrower. Secondly, we have strategy diversification, so we can diversify risk-return drivers. So, for example, lending against a company's operating cash flows versus income earned from a pool of assets, as well as having that flexibility to work through changing markets. The next thing I'd say is none of this really matters if you don't have top quality managers, and that's really critical. So for Australian investors, while local private credit is relatively easy to access, it's much more difficult to assess and access US and European funds, which is why we partnered with Mercer, who are our investment consultant. They have a massive global footprint and proven manager selection capability. So selecting the best managers, gaining access and diversifying is difficult, and it's practically impossible to achieve for all but institutional size investors. And we're able to do this by leveraging Mercer's global dedicated private credit research team, who's solely focused on assessing and rating funds as new ones come to market, as well as continuing to monitor existing funds on an ongoing basis. So leveraging their capability, we feel we get the access to the best managers, and then we really ensure that we aren't reliant on any single manager. And so that's why we have multiple managers, so we can minimize any individual business and performance risk while also building in the flexibility that I spoke about before. So when you put all that together, what we have is a very diverse portfolio that's easy to access, well positioned within not only the current environment, but also to be adapted to changing market conditions and opportunity sets. Just to the next slide, please, Dane. Now, so to enable us to deliver these 4 different points of access to our investors, we assign our managers to 3 different buckets, which are the building blocks to all of our different portfolios. And this allows us to diversify and generate attractive cash distributions whilst also growing or accumulating the value of the portfolio on a diversified basis. So these 3 buckets, the income bucket that you see on the left, that really drives the cash yield and resilience of the fund. It's all senior direct lending to mid-market corporates and defensive industries. The returns are driven by cash interest, which we receive from the managers either on a monthly or quarterly basis, depending on the payment profile of the manager. And so today we have 7 managers across the US and Europe with well over 1,000 individual loans in that portfolio. Balanced is about providing cash yield from senior direct lending, but in these managers, you also have the flexibility to earn more significant returns through their ability to be opportunistic with different strategies as markets get dislocated. So in this context, we earn nice cash yields, but we also get accumulation through participation in opportunistic strategies through market changes and dislocation. And then finally, our total return bucket, these are all funds that earn equity-like returns. And so these funds, they don't pay interest along the way. Rather what they do is they reinvest returns received into new opportunities. So they recycle capital. And also they get equity from borrowers as part of providing borrowers with kind of some unique bespoke capital solutions. So what happens in those funds is they accumulate returns until the end of their fund's life, when they harvest those returns and they distribute them to investors. So for PCX, for us to deliver the minimum 7% distribution with some NAV accumulation over time to meet our internal RBA plus 6 target, we invest 60% in the income bucket, 20% in the balance bucket, and 10% of the total return bucket. And that's how you actually get to the cash distributions and the total return target. So we just go to the next slide. I just wanted to take a little bit of time to kind of bring this to life in terms of what actually happens in the underlying portfolio. So what we thought we'd do is kind of walk through a couple of different examples. One comes from our income managers, and one comes from our total return bucket. So we haven't done one specifically for balance because these 2 examples are really characteristics of what you might see in a balance manager. So this example that you see up on the screen for income, I guess to reiterate, we're focusing on senior direct lenders who have strong origination, proven underwriting capabilities, and returns over time with really strong structural protections in place for the loans that they make. Now, this is an example from one of our US managers, and this is really indicative of what we actually aim to achieve out of the lenders in this portfolio. So in this example, we have a private equity firm that was actually looking to acquire a leading B2B commerce business that actually makes compliance signs and labels for regulatory purposes. So, for example, road rule signs like stop signs, traffic signs, and OH&S type signs like your slippery when wet signs, as an example. Now, The process for the sale of this asset was a contested process, and what this firm needed was speed, certainty, and confidentiality. So they actually approached our manager on an exclusive basis, given the strong historical relationship our manager had with the firm, as well as their trust and their ability to deliver the solution quickly and confidentially. So the business case of the underlying loan, well, the business was a leading business in the industry with a very strong market position, a highly diversified revenue base with top 10 customers representing less than 4% of the revenue, very strong customer retention and repeat business. They participate in a growing industry that had aging signage. There was a shift happening at the underlying customer base from direct purchase to online procurement, and increasing revenue requirements, which was increasing the need for these sorts of signs, tags, labels. So, for example, post-COVID, a massive increase for OH&S regulations. And then thirdly, the company had very attractive, predictable cash flow profile, really nice margin structure, cost flexibility, and very minimal CapEx needs. So this is sort of a classic business profile for a direct lender because it's recession resistant, highly diversified revenue, very strong market position, attractive profit margins, and a very predictable cash flow. So the end result here was a $75 million loan that was against a value of about $230 million. So that's a loan to value ratio of about 30%. They got a really nice cash yield of 10.5% and strong covenant protections, notwithstanding the fact that this company was very defensive, high quality. So that's an example of the types of loans that our underlying managers in the income bucket are seeking to deploy capital into. So just to the next slide to give you an example of a total return. Now this example is one I thought I'd pick so you can get an understanding of kind of the diversification of strategy. So this is one of our managers who's a very large specialized asset-based credit expert. And so they're very well positioned to originate new opportunities based on some more recent changes in bank regulation, where lots of banks are actually now looking at selling off asset pools for particular reasons. So in this example, we have a regional US bank that ran into liquidity and capital issues due to change regulations after the collapse of Silicon Valley Bank and First Republic in the US. So what they did was, this bank did is they invited a small group of qualified bidders to review the purchase of assets off their balance sheet. Now, this situation was very confidential and sensitive, given that if they had a leak that they were trying to sell the assets to shore up their liquidity position, it could have created a run on the bank. So they chose bidders on the basis that they could keep the situation confidential and that they could act very quickly. Now, our manager ended up being the preferred party, given it has a very deep and proven expertise in asset-backed lending, had very large scale, so they had the ability within their portfolio to purchase these assets without actually having any portfolio concentration issues. They had the ability to underwrite the variety of assets that was actually being offered by the bank, had a very positive reputation in the market, and they had a relationship with the bank and the key counterparties who were really important to give consent to the purchase of those assets. The business case for the manager of what they were buying, very diverse portfolio of high quality assets. The manager was able to actually cherry pick the assets that they wanted so they could exclude things that they didn't like. And finally, they got very conservative underwriting assumptions. So for every $145 of assets, they paid $100. So this was well over collateralized. So the end result, $386 million investment, conservatively underwritten at an IRR of 18%, but they actually realized about 29% because the actual outcome of this was they beat their underwritten conservative case. So this is an example of the kinds of opportunities that can arise across our total return managers. So I hope these examples will help to illustrate for you both the defensive and the opportunistic characteristics that we purposely curated in our portfolio construction. And I think it's important to note that this is really unique to be able to deliver access to these types of opportunities with a wide diversification, attractive liquidity characteristics with top managers, all in one portfolio. So I think with that, what I'll do is hand over to Adam, our portfolio manager, so he can discuss sort of the portfolio composition and performance.
If we can move to the next slide. So this slide shows current positioning across the portfolio, which is invested across 20 underlying funds plus cash. Roughly 60% is invested in income funds, which pay the majority of their returns in distributions, and this then underpins the 7% monthly distribution to shareholders. Another 30% is invested in total return and balance funds, which target the higher returns and aim to grow the net asset value of the portfolio. The remaining roughly 12% is held in cash, which supports the contingent liquidity needs of the fund. The portfolio is well diversified across geographies, with about 2/3 invested in US funds and 1/3 invested in European funds. It's also well diversified across strategies, with the majority of exposure to direct lending and the balance splits across various strategies targeting those higher returns. In terms of seniority, most of the portfolio is invested in senior secured first lien loans, with about 20% invested lower down the capital stack, which is designed to boost total returns. If we could move to the next slide. This one focuses on the performance to date. Although the fund only listed in June, we've deployed all of the capital in line with our target allocations. We're paying our target minimum yield of 7%, funded by the strong cash flows from our income managers. So overall, we're happy with the development of the portfolio and the returns generated by our managers, who are all performing at or above target. I'll now hand back to Nehemiah just to wrap up.
So thanks for that, Adam. Look, just to close off, just to leave you with a few takeaways. The first is market environment remains very attractive for global private credit, which I covered earlier. Our managers are all performing at or above their target returns. Our portfolio of 20 managers and over 2,000 loans in the US and Europe is very well positioned to deliver sustainable, predictable cash yield, attractive total returns, and provide defensive capital protection through market uncertainties and economic cycles. So this combination of diversification, returns, liquidity, and flexibility, we think it's very unique and difficult to replicate, and we're really proud to be able to make global private credit accessible in this fashion to all Australian investors. And so with that, I'll open it up to questions.
Thanks, Nehemiah and Adam. It was a very good insight into, I guess, what's going on inside the portfolio. Just as a reminder, you can keep asking questions. The Q&A box is on your screen. We've already got a few that have come through, but happy to answer as many as we can in the time that we've got left. I'll start from the top and we can go from there. Adam, I might hand this one to you. And if we can keep them maybe rapid fire, that'd be amazing. What is the current running yield on the portfolio?
Yep, sure. So as I said, we're currently paying 7% per annum, payable monthly, and we expect to continue doing that in the future.
And can that 7%, I'll just jump in with another question I've received from some advisors, could that actually be bigger than 7%?
In theory, if we start to accumulate NAV, we do have the opportunity to pay special distributions. It'll take a bit of time for the NAV to accumulate to that point, but yes, down the track, it is possible.
Cool. Can I just maybe make one quick distinction as well when we're actually talking about the cash yield? Something about just the underlying question here. So the other part of it is for the income funds, which are all cash interest paying. That's I think the sort of broad yield profile of those is around 10% plus at the moment. Or correct me if I'm wrong, Raps. And then for the rest of the portfolio, remember that they don't pay cash out, but they actually earn returns equal to or in excess of that in their underlying portfolios. But those returns aren't distributed; they will accumulate over time.
Which maybe we can expand a little bit further on that. I've got two questions that sort of link to that point, Nehemiah. The first one, sort of given the limited upside of private credit, how is a manager eligible for a performance fee? But linking to that, I guess, is how will that NAV grow through the course of time? I think they're kind of related to some extent.
Yeah. So, Raps, do you want to touch on maybe how the total return accumulates over time? Then I can address. I can add on to it. I can add on to it.
Yeah, sure. So as we said, the income managers are really designed to pay the running yield, but those those more equity-like returns in the total return managers, and to an extent the balance managers, are really where we start to see the incremental returns in NAV over time. So they take more time to realize returns, but as they do, we should see good kickers in returns, and that will accumulate through our NAV.
Yes, and the only other thing to add to that, and this goes to the total return bucket in particular, which is that it's very hard to diversify in that bucket, okay? Because these are all individual closed-end funds, and individual closed-end funds that run different strategies also run more concentrated portfolios that are with a net return target that would be in the mid-teens or above, right? Which is not just accumulation of yield and then recycling capital. You get equity as part of the solutions that you provide for most of those strategies. Very difficult to get the best managers, to get access to the managers, to take capital and deploy it quickly into those managers, because typically it takes up to 3-4 years for these funds to be invested. So for us, what we've been able to do is not only diversify to get rid of any individual manager concentration risk, we've actually started investing capital a couple of years ago to kind of minimize the drag that's associated with investing in these funds. And so in part, the performance fee is actually a representation of, well, we have to perform across the board. We actually have to deliver accumulation at the edge, and we've actually spent real capital from 2 years ago to start to open those pipes to minimize kind of the drag that you would typically associate with closed-end funds. So the last part of that is to then answer the question of what do you do, when will you start to see the accumulation? Well, because of the lag of you invest, the fund invests the money, and then they report the returns subsequently, we should start to really see the accumulation in the underlying NAVs that will commence from the first quarter of next year. But we can already have line of sight today of what those returns are. It takes a bit of time for them to actually report to us the audited independent valuations of the funds that represent those returns.
Thanks for that. And there's a question here on if we can name some of the underlying managers. I think what is resonating with the conversations that I'm having with people is just that rich, longer history that the overseas private credit managers have versus the Australian option. So if we could just draw out maybe some of the names that are inside the portfolio and just how long they've been around and what they've seen, that'd be amazing.
Yeah, so this is a bit of a tricky question. Okay, so we can name a few managers, but also I should caveat, the reason we are very happy to be transparent about every single one of our managers, but we are limited by our ability to disclose who they are because they have their own regulations and their own concerns from a regulatory compliance perspective of actually disclosing their names, and that's just because of participation of non-institutional investors and the risk that their internal compliance sees in products that are sold to retail. But a couple of managers that I can name in our income bucket, one is a U.S. manager by the name of Churchill, one of the longest standing core middle market direct lenders in the U.S. Very blue chip, very strong track record of very consistent and sustainable performance, really since the GFC. Another is Golub Capital, which has the same type of lineage. So there's just a couple that I know I can actually mention because we've had permission to mention their names.
And there's another one, I guess, that's tying to that. So we've got in this portfolio, we've mentioned 20 managers, over 2,000 positions, probably more than that when you get a look through in some of the funds. How do we ensure that we're not over diversifying this portfolio, that all managers are contributing?
Yeah, it's an interesting question, that one. Sorry. So I guess in relation to this, there's sort of four things or three things. The first is the philosophy of diversification is really to ensure that we select managers that are resilient, they're flexible to capture relative value opportunities, etc. But every manager we put in the portfolio It's actually done with very specific reasons in mind to ensure that we're minimizing downside risk, we're maximizing returns, we're mitigating concentration, and we're maintaining low volatility in the net asset value. Okay, so that's kind of overarching principle. Now, the things that are really critical and how you manage performance and are we over diversifying? Well, we would say no, because we're very deliberate in the way we choose. Secondly, that selection is very important because that's the first line of defense, really, is the DD that you do on the manager. So our manager selection process, which is managed by Mercer, really focuses on very strong investment DD. So it's about the quality of the manager, their investment process, their sourcing, their pipeline management, how they create value, and their track record of performance, and very specifically where they participate within the market. Because what we don't want to do, right, is to have an overconcentration of people going after the exact same pool of underlying opportunities, as an example. So the manager selection process and diligence process is really important. Thirdly, the monitoring of the managers is really important. And so within the context of managing it, we have a very regular dialogue with our managers regarding performance. It's important to note that with income managers, they're all open-ended funds. So if we ever saw something that said to us, we think the manager might underperform, we don't like the performance, it's very easy for us to redeem and actually invest, and higher weightings into other managers on that basis. Now, total return managers, you can't do that with because they're closed-end funds. And that's why within that, not only is the selection of the managers important, that's where the different types of strategies that they run, how they actually play those strategies, the different risk-return drivers of those strategies ensures that over a cycle, we're able to ensure we're maximizing the overall outcome to the extent that you have any one of these funds underperform. And that's why it's really important. You just cannot get into total return funds that generate these returns. And have that level of flexibility and diversification to kind of try to get the best risk-adjusted return overall through cycles.
So we've probably got time for maybe two more questions. There's one here. It's obviously someone that's a little bit cynical of the Australian credit cycle, saying many private credit managers in Australia are sort of yet to experience prolonged economic downturns. So therefore, they haven't been through a full cycle. What has the experience of the global managers in the portfolio been through some downturns that maybe have occurred in the US or Europe?
Yeah, maybe Adam, do you want to touch on that, and I can amplify if anything?
Yeah, sure. So we'll use, for example, Churchill, which I mentioned as an example. So they've got track record going back to 2004. So they've been through the GFC, they've been through COVID. Various other downturns. And what we've seen is very low loss rates and very strong performance through those periods. I think Churchill over that 20-year plus period averages annual loss rates of less than 20 basis points. Peaking in just after the GFC at around 1%. So you've seen them go through all of those economic cycles with very limited impact on their returns.
Thanks, Adam. And just finally, this is probably a good question to round it all out. This is someone who sounds like they're not a preference for unlisted. So they're saying PCX, I like the product, but it's I prefer unlisted assets. Are you thinking about sort of producing or providing any options that are like PCX but unlisted?
Yes, so it's a short answer. But so if we just step back and say kind of what actually did we provide? So firstly, the great thing about our master portfolio is the ability to create different types of products with different return profiles and different liquidity profiles. So, we got one point of access, which is our Term Plus business, which is sort of 1 and 2 year and 5-year term accounts. But I'll focus on 1 to 2 because it's the shorter term and it's a good alternative, for 1 to 2 year cash. Earns, nice 300 and 365 basis points. So 7.35% today with 1 year, 8% for 2 year, but I focus, those are variable rate products. We also have a wholesale fund, which is a target of RBA of 7 to 9%. And that's got a 3-year lockup because it's got over a third of the portfolio in total return, which doesn't pay that cash yield and accumulates. So really good for investors who want defensiveness with accumulation and growth. And then we are currently working on a product which we hope to release early next year, which is an unlisted retail product that looks very similar to PCX, but because it's unlisted and the listing provides you with a bit of underlying liquidity, because it's unlisted, might have a slightly lower return profile because it actually has to be in the more liquid parts of our portfolio. But we're currently working on the terms and frankly would appreciate as we work through that product, any feedback people have of what they are looking for in that space, we're really happy to listen to and understand what would be important to you and see if we can incorporate some of that into the ultimate design of the product that we plan to launch in the first quarter of next year.
Thanks, Nehemiah, and thanks, Adam. And just to echo Nehemiah's comments there, if you do have any feedback on products that are in that space and unlisted, please reach out to one of your Pengana representatives. If you don't know who that is, that'll be on the website, pengana.com. We'd like to thank you for your attendance and certainly for your questions along today. It certainly helps shape these presentations to respond to the questions that you're actually interested in this particular space. Once again, thank you for your attendance, and we look forward to seeing you again shortly.